Hey, what's up? It's your favorite local real estate agent, Eren Millam with Premier Property Group. Today, we're going to be reviewing another video. You guys seem to be liking those more than my information videos. Anyways, so we're going to be doing another review of this video. I found, I believe his guy's name is Larry Lee. He made a video called Housing Market Predictions. The 2023 housing crash has just begun. All right, so as you know from watching these other videos that I've done, all of these people, they seem to be following a data trend, at least nationally, that doesn't really fit the Lewis County area. So I want to take a look at what he's got to say, and then I'm gonna give you the facts on the ground of what's going on here in Lewis County. And again, we'll find out if he's selling something, because the majority of these people are giving you this information as a way to get you to buy their stuff. Now, I've also been accused that if I give you information, I'm trying to sell you real estate. That's not the case. Whether or not you buy a house, that doesn't really affect if you buy a house in Lewis County or if you buy a house through me. So I'm not directly selling you something. I'm just a big believer in real estate. So with that said, let's take a look.
Now, let's recap the consumer and big picture macro. We can see here that home prices have actually risen this year despite the high inflation and hawkish Fed rhetoric that we've seen throughout the year. And we're seeing the US Consumer Confidence Index jump to the highest level since early 2022. And because of this, many regions in the US, home prices are actually ticking higher. Now, in my opinion, the biggest bubble is actually not in stocks. The biggest bubble that I see right now is in housing. Why do I believe that? That's because the income to house price ratio is essentially at multi-decade lows, and affordability is extremely difficult for a lot of millennials and Gen Z, which makes me believe that the only people that can really participate in real estate right now are investors or very well-heeled individuals.
All right, so I've definitely heard this, that people are saying the housing market is so unaffordable that the only people are doing involved are rich people or investors. Now, I'm not saying that that activity is not going on, but not a lot of it is going on. The people who are buying are people who are qualified to buy. It's no different. I'm not seeing large corporations buying up a ton of land or apartments or anything. These are regular local people. Yes, real estate is very expensive. However, it's still the number one investment tool of the wealthy. So let's continue to see what he's saying.
So people think that the housing market is strong, but I personally think it's not strong at all. It's illiquid. That's what's keeping prices high. I've got a lot of data to share with you today. Let's take a look at this chart here. It's the supply of housing inventory. We can see that it's tighter than ever. In fact, the number of homes for sale drops now to the lowest level on record. This is artificially keeping prices high. It's not because there's a lot of demand, it's because the supply is extremely tight.
Okay, so that's huge. We need to talk about that. So he's saying it's not because the demand is high, it's because inventory is super low. So inventory being super low, it's not an artificial thing. Our inventory across the nation, and especially in Lewis County, is super low. So that is keeping prices high because there's less to choose from. It's like supply and demand. There is still more buyer demand than there is available inventory of homes. And I think you'll see that when the interest rate goes down, you're going to see more activity from buyers. There's a lot of pent-up demand is what these interest rates have caused. And once they lower, the floodgates are going to open. So I can see how he's looking at the same data and coming to a different conclusion. It doesn't fit Lewis County. We'll just leave it there.
And because the mortgage rates now are north of 7%, and depending on your credit score, could get close to 8% for the 30-year, the market is actually becoming more and more illiquid, where there are fewer sellers on the market and fewer buyers at certain price ranges for residential. Now, if we take a look at this table here, this was back in May 2023, just a quarter ago, we can see that new listings, they're actually falling at a very rapid pace. And this is the metric that we should follow because this is constraining the prices from falling further to make it more affordable.
Okay, yeah, so he's just showing data that the inventory is going down further and further and further. And that's why prices are going up and making things so expensive. We agree.
Now, there is an optimistic and contrarian view about why the real estate sector continues to stay supported despite all the data that says that it should go lower.
Yeah, so I would say that is my view, the opportunistic view. So people are looking at this data and they're seeing red flags. And I'm not seeing red flags that we saw, for example, in 2007, 2008, when it really did crash, was because we had a lot of inventory. We had so many homes. They were building them so fast. They were making loans for people who could not afford them. And then there was a recession. People lost jobs, had to foreclose on homes. We're not seeing a ton of foreclosures right now. It's not that the economy is doing so bad that people can't afford things. Now, on the flip side, let's say, I mean, we've been going through a recession. I haven't seen a lot of people losing their jobs. Maybe I'm just not informed in that realm, but it seems like there's tons of job openings for people. People want to hire and they can't find the workers. So the information we have is from the 2008 crash. Every single data point is completely opposite. So what that tells me is the bubble is not real estate. The bubble is what the Fed is doing by artificially trying to stop these prices from going up. And they may cause more damage than they do good. So let's keep watching.
This is because some economists think that when rates fall even slightly, there could be a surge in buyers to make inventory even more limited. If we take a look at this chart, nearly half of home offers faced bidding wars just a quarter ago. That's pretty significant, even though the economy in the US is softening.
So yeah, exactly what he said is we are seeing bidding wars. If you have a home that is priced correctly, there is enough demand in the market that you're going to get multiple offers and bidding wars. That is still a thing. However, for the most part, that is in the lower level of homes under the average, which right now is about 460. So as you go up into those upper tiers, you're going to see a lot longer times on market. That's just what it is. You may see a lot more price reductions. But for the homes that people can afford, you are seeing lots of competition.
And because of these robust cash offers, it continues to be one of the biggest barriers to affordable housing. We can see here that 1/3 of US home purchases were actually made in cash about a quarter ago, earlier this year. And because of this, housing prices are actually ticking higher and rebounding from the decline that we've seen so far, and this could reignite inflation concerns later this year and in 2024. Now, if we dissect the housing market, the best performing part in housing is the modestly priced residential areas. So the lower priced homes across the US, those are the areas that continue to be resilient. All other price ranges, many other price tiers within housing, especially if it's north of 500,000, those homes are having much more difficulty selling depending on the neighborhood. We can see from this map.
Yeah, so he's saying exactly what I'm saying. The lower price is more resilient. He did mention something about the economy or the housing market had a dip and then it's rebounding. It's exactly what we're seeing in Lewis County. From July to December of 2022, we saw about a 10% dip overall, and it's been climbing. It's kind of been like fluttering on its way up, but the market does seem to be rebounding. I think people thought the wheels were going to fall off. It was 2008 again. People are seeing that's not actually the case, and so they're coming back. Now, he said it's because there's a ton of investors coming in the market. I don't believe that's the case. And let's just be honest, if there's a ton of investors flooding the market, then you need to get in as soon as possible, because if that were true, then the market's going to go up really high. It's not going to fall. So I guess that's where the problem is, because a lot of these things he's saying are true. He's just reading it as the way that it's not supposed to be. I don't know exactly how to say this, but we're looking at the same data and he's coming up with a conclusion that supports his beliefs rather than following the data. I think that's the key. So let's keep listening.
That neighborhoods like Rochester, Hartford, Portland, Worcester, Allentown, these neighborhoods within the states on this map, these are the neighborhoods that continue to sell well because those homes are selling at modest prices. Now, with the 30-year mortgage rate now rising above 7%, and depending on your credit score, reaching 8%, I believe that this market is becoming more and more illiquid. So be careful if you're a first homeowner and be a smart consumer. We can see here that Elon Musk talked about commercial real estate melting down fast and that home values are next.
Okay, so this is one of those things where I'm looking for evidence to support my belief rather than actually following the fact. The commercial real estate market is totally different and totally unrelated. I know that sounds weird, but commercial is like business and buildings. It's not residential. There's always a demand for residential. There may or may not always be demand for commercial in a given area. For example, Detroit over the last 20 years, okay? But there's still people living there, so there's still a demand for housing, even though that's probably not the best example. All right, let's keep watching.
Now let's talk about real estate investors. And I want to show you some data and helpful psychology behind a major force driving housing values in residential. This is going to be eye-opening. Look at this chart here. Investors, they own 1 out of 10 homes for sale. That is substantial because that means investors have a very big impact on housing prices going forward. We can see that investor market share in terms of the percentage of total home sales in which an investor was the buyer was 18% in the first quarter of 2023. And we can also see that investor activity has tapered down significantly this year from prior years. This is important to realize because if this activity continues to decelerate, there is a very good chance that housing prices will fall later this year and in 2024, especially once supply picks up.
Okay, I have no idea how he makes this connection. If the investors own 18% of the homes and they are selling 10% of the homes, it means they're capitalizing on the market. As you've seen, rentals are hard to come by as well. So for the most part, I would think most investors are holding on to their homes and collecting that cash flow. So what he's saying is investors are going to try and sell their properties because why? That's what I'm not. I can't find a reason other than to if you can fill it with a renter, why would you want to sell it? And if you can't fill it with a renter, then yeah, you want to sell it. But there's no reason for landlords to be putting their homes on the market. But he's making an assumption here that these landlords are all going to put their homes on the market. And if they own 18% of the market, that's 1/5 of the market. So he's saying the market's going to drop 20%. Is that what he's saying? I'm not exactly following the logic here.
We can see investor purchases are really starting to tick down in 2023, and investors are also forced to target affordable properties, not properties across the entire price range. They're really focusing on the affordable properties. Now, here's an important signal to watch, and this is key. Watch for investors and their activity to stop buying residential. A lot of realtors are saying that once investors pull back from the residential market, it's likely that there's going to be a lot less bidding wars, and sellers will have a much harder time trying to sell their houses above their list price.
Okay, now I get it. So he's saying they're not selling, they're trying to buy a bunch of homes. And when they stop buying, that's when the pressure on the prices will stop because there'll be less demand. He's also saying that these investors represent up to 1/5 of the market, right? So if you have 5 people making an offer on your home and the investors pull out, you still have 4 people making an offer on your home. Are there investors going after affordable properties? Sure, why wouldn't they be? But here's the thing. Investors don't stop buying properties. They're investors. That's what they do. So they're always going to be looking for a good deal. And if you get out of the market, that's good for them because then they don't have to compete against you. If less buyers, then they're going to be able to snag up more properties. So when they stop buying homes, that's good news for you because then you have less competition.
Now, we can also see from the data that low-price homes make up nearly 1/2 of investor purchases, and 2 in 5 homes bought by investors are starter homes. This is actually rising to a multi-decade high. This is why housing feels so unaffordable, because even in the affordable sections of the market, we're seeing investors come in and swoop in and use all-cash offers to buy those homes.
Okay, so now we're kind of getting inflammatory a little bit. You can see the average there this is a record high, okay? So it is a record high, but what's the context? The context is the average was about 35% for the entire time, and now it's gone up to 41%. And why are they doing that? It's because that's the level they're always at. It's just that the prices have gone up, so they've had to move down. Does that make sense? There's really no big secret here. Let's keep watching, but I keep losing respect for this guy just because he's making so many jumps to fulfill his own narrative rather than just following the data.
But it hasn't been an easy ride for investors across the board. We can see here that investors are most likely to sell at losses in cyclical areas that have risen substantially since the pandemic because of their low inventory supply. Areas like Phoenix and Las Vegas, these are areas that investors are actually losing substantial amounts of money in. And if investors have to cut losses in those regions, there's a good chance that they may pull back in other regions as well as liquidity dries up. Now we can see here that in Phoenix, investors lost money on 30% of homes they sold in March. And this may continue to go higher as mortgage rates stay stubbornly high above 7%. Now let's talk about renting versus owning a home. I know a lot of us want to own a home and we're constantly debating whether we should rent or whether we should own. So we can see here from this chart that in most cities in the US, it is now far more affordable to rent. There is a huge premium to pay the mortgage versus the rent, especially after you account for property taxes, maintenance costs, and operating repairs. There are also some secondary signals that we should watch for in the real estate market.
As a real estate agent, I completely disagree. As a general person, I 100% vehemently disagree. You should never consider renting when you can own for multiple reasons. Number one of which is financially, because if you're renting versus paying a mortgage, the difference is instead of paying your own mortgage, you're paying your landlord's mortgage. Okay, there's a reason why he owns the real estate and collects the rent from you versus you owning the real estate and building your own equity. So if you're saying, hey, renting is more affordable, then you need to work on saving up enough money to where you can buy. So for example, anyone who bought a home in 2018, for the most part, between 2018 and 2021, and now it's kind of gone up and stabilized a little bit, but in that time frame, your equity doubled for the most part. So the difference between 2015 and 2018, your equity doubled during that time as well. Now, if you were renting that entire time, let's say you're paying $1,500 a month, you've lost $18,000 a year for 6 years. That's $108,000 that you lost versus, let's say you bought a $150,000 home. It's now $450,000. So you've got $300,000 of equity. Now, I'm not saying that's normal and that's what's going to happen every time, but on average, equity accumulation is around 4% a year over 100 years. So on average, you're going to gain about 4% a year. Now, if you're renting, you're just losing money. So renting is never financial wise decision. And he's talking about, he wants you to be careful out there and make good decisions. Well, if he's telling you to rent, then it's not someone you should be listening to for a multitude of reasons. If you want me to go into them, I can go into them, but just in general, it doesn't make sense. Not to mention the lifestyle you're going to leave. I mean, who likes renting? Nobody likes renting.
And this is the investor activity for Airbnb and VRBO. Allow me to explain. We can see here that there are private equity and public funds, such as Invitation Homes, that actually go out, buy homes, rent them out, and they are buying those homes for tourists only. Essentially, they're using it for Airbnb and VRBO type of activity. Why does this matter? Because these homes are now pulled out of the supply, the inventory. They're not available for people to live in, and it's only available for tourists. And because of this, the supply of the inventory actually goes down, and that drives housing prices in that neighborhood to go higher. We can see how important investor activity was based on the data I showed you earlier in this video. Now, if these investors start dumping these Airbnb and VRBO properties, what's going to happen is that the supply of homes in these neighborhoods will then rise, and therefore that's going to cause pressure for home prices in that region. So this is another signal that we can watch for the impending correction that I'm expecting in the real estate sector later this year and in 2024.
Okay, so looking at the correct data and making an assumption that fits his narrative. So let's say these real estate investors are buying these properties and doing VRBOs. What's going to make them stop? The only thing I can think of is a massive recession or something where people lose their jobs and they're not vacationing and doing all of that, right? So if they sell, let's say, they bought 40% of the homes and they all at one time decide they're all going to list their homes, the amount of buyer demand is still greater than the amount of homes that they can put on the market. Again, my example, if there's 5 buyers for each home, now there would be 5 buyers for 3 homes. And so that's the part that he's not picking up. He's saying it's a direct correlation. There's going to be more homes, so the prices are going to go down. So he's not actually looking at the data on the ground. He's looking at this overarching data, and he's making an assumption that fits his narratives. He's not following the data. So be careful who you listen to on YouTube. Not me, of course. You can trust me.
We can also see that the activity for house flipping is also rapidly slowing down. And because home flippers aren't reaping the gains they used to, they're forced to sell homes at losses after deducting for operating costs and property taxes. These housing speculators, they're on the hook for operating expenses, and if they can't offload them fast enough, this could create problems for real estate investors going forward. Now, here's my opinion, and of course this is not financial advice, but I think that now is not only a bad time to get into housing, to buy your first home, it's probably the worst time, unless you are an all-cash buyer. In that case, your circumstances are different.
Okay, so he's telling you not to buy a home. Why is he telling you not to buy a home? Is he telling you that because prices are going to go down And then is he going to say you should buy a home then? I would always say it is always a good time to buy a home because you're always going to be building equity. It's going to fit your lifestyle, a whole bunch of reasons. If you think the prices are going to go down, I understand why you would consider not buying. However, if prices are going down, how likely are sellers to put their homes on the market? They're less likely unless they need to move somewhere. So it's not a direct correlation. If prices are going down, less people are putting their home on the market. So there's still going to be more demand, and that's still going to push prices up because our inventory is so low. That's the key. I'll give you an example. I put a home on the market, Napavine. It's a nice area. We had 12 showings in 2 days, and I shut down a bunch of other showings because we already had 5 offers. And sellers are like, we can't do this anymore. Like, let's just make these 5 offers work. So let's say the price went down. There's going to be more buyers trying to get that house if it ever does come on the market. But if the price was going to be less, those sellers wouldn't leave. In this situation, they already had another home, they were already gone. So they had to put their home on the market. So in that case, that's the reason why it came on, not because prices were going up or low. And that's the key that people are not considering is we're in a market where people are doing things because they have to, not because they want to. There's no speculators like, oh, I want to put my house up and see if it sells for this great amount. They know it's going to sell, but they're like, where am I going to go? So the people who are doing stuff are because they need to. And that is a factor that Mr. Larry here is not considering. He's looking at data to fit his narrative. I know I keep saying that. So anyways, let's keep watching.
Because once the unemployment rate goes higher, the housing market will transform from an illiquid to a potentially declining asset class as supply of homes goes higher and the ability of people to enter the market actually declines with joblessness increasing. So it's time to get cautious in housing, and it's definitely not an area that I think is promising over the next 6 to 9 months.
Okay. So his general statement is right now investors are buying homes and there will come a point where they stop. And at that point, people will start losing their jobs as well. And then a bunch of inventory is going to come on the market. And when it does, it's going to push prices down because there's not going to be anyone who's going to be able to afford to buy the homes that are on the market. So I think that's his general statement. It lacks any context, real context for what the situation is actually on the ground. Our inventory is so incredibly low. If we lost, well, we have lost half of our buyers because of interest rates. The amount of deals that are happening are way low. And yet the prices are still going up because there's so low inventory. I know nationally some places are going down, but the reason why they're going down is because they have a ton of inventory. And we don't have that here. And then again, all the places that he said that had huge price increases, now they're coming down. They did have huge price increases, and they also had an influx of building. And so now they have a surplus. And in our area, we don't. There's still more buyer demand than supply. All right. Leave a comment down below whether you agree or disagree, and let's talk about it and see if we can convince each other. And remember, my name is Eren Millam with Premier Property Group. Never settle for less than extraordinary.